If you drive for a delivery app, freelance online, or run any kind of side business and get paid without taxes taken out, there's a rule the IRS enforces on millions of people every year, and almost nobody explains it before the penalty shows up. When you're a W-2 employee, your employer withholds tax from every paycheck automatically. When you're paid on a 1099 as a freelancer, contractor, or gig worker, nothing is withheld. You get the full amount. And that's exactly where the trap begins. By the end of this video, you'll understand exactly how this penalty works, why it catches so many self-employed workers by surprise, and the simple system that avoids it completely for the rest of your working life. Here's the mistake almost every new freelancer makes: they assume taxes are a once-a-year problem, due in April, just like they were as an employee. For 1099 income, that assumption is wrong, and it's expensive. The IRS expects self-employed workers to pay taxes as the money is earned, in 4 installments across the year, not once, at the end. This is called quarterly estimated tax. If you don't pay enough throughout the year, whether through estimated payments or otherwise, the IRS charges what's officially called an underpayment penalty. It's not a late fee. It's calculated like interest, and it grows the longer the gap goes unpaid. Here's the part that surprises people the most: this penalty applies even if you pay your full tax bill in April, on time, in one lump sum. Paying in full isn't enough, the IRS wants it paid across the year, roughly matching when you actually earned it. There's a safe harbor most freelancers have never heard of. If you're withholding an estimated payments for the year add up to at least 90% of what you owe this year, or 100% of what you owed last year, 110% if your income is higher, you generally avoid the penalty entirely, even if you end up owing more when you file. That gives you a target. Take what you owed last year, divide it by 4, and that's a reasonable quarterly payment to make, adjusted upward if this year's income is clearly higher. The payments are made using a form called 1040-ES, and they're due 4 times a year, not neatly split into calendar quarters, so the actual dates matter. Missing even one due date is what typically triggers the penalty calculation. You can pay directly through the IRS's own online payment system in a few minutes, no accountant, no mail check required, no fee for a direct bank transfer. The habit that prevents this permanently: every time you get paid on a 1099, set aside a fixed percentage. Many self-employed workers use 25 to 30% as a starting estimate into a separate savings account earmarked only for taxes. When the quarterly due date comes, the money is already sitting there, waiting. This single habit is the difference between freelancers who dread tax season and freelancers who barely think about it. 3 things to do starting today. Know your 4 due dates and don't miss one. Aim for the safe harbor, roughly last year's tax bill divided into 4 payments. And set aside a percentage of every 1099 payment the moment it arrives, so the money is never a surprise when it's due. Nobody hands freelancers a manual when the first 1099 arrives. Now you have the part that actually matters. We track the financial traps that don't make headlines so you're never caught off guard. If this helped, subscribe. We post every day. I'll see you in the next one.